This book explains how financial data could be processed under a data-driven approach. It shows how, under this approach, machine learning can be used to detect regime changes in the market, and how that could support algorithmic trading. Artificial intelligence involves two important parts: knowledge representation and search. How you represent knowledge determines what you can reason about. In this book, we use directional change to summarize financial data. I shall explain what it is in a moment. We use machine learning to process information captured under directional change and use knowledge thus generated to support trading. A directional change event is a price change in the opposite direction of the current trend by a specific threshold. Different observers may use different thresholds. In this slide, a red arrow represents a directional change of 5%. Here is the first directional change, as price has dropped by 5% from the peak. Here is the second directional change, as price has risen by 5% from the trough. Thus, the market is partitioned into alternating downtrends and uptrends. Traders are familiar to downtrends and uptrends. They refer to them as bear and bull markets. Directional change can be seen as a robust definition of bear and bull markets. This is a non-trivial step, as we need robust definitions to support the science that we are about to explain. I have prepared a separate video to explain the details of directional change. By summarizing market dynamics with directional change, we gain new perspectives of the market. For example, for each trend, we can measure the total price movement, TMV, which is the price change from the beginning to the end of the trend. We can also measure the time that it takes to complete a trend. We can measure the volatility of the market by the average TMV values and average T values for a given period. We can also measure the return of each trend. We shall now explain how market regimes can be detected under directional change. This research is entirely data-driven, so we always start with data. First, we partition the market into trends as explained above. For each trend, we can measure the total movement, TMV, and time, T. We can then calculate the return, R. Next, we feed the sequence of returns into a hidden Markov model. A hidden Markov model is a way of relating a sequence of observations to a sequence of hidden states. Here, we assume that the returns that we observed were driven by the hidden states of the market. The hidden states reflect the regimes that the market was in. We asked the hidden Markov model to classify the trends into two regimes. Nobody knew whether financial data fits into a hidden Markov model and with two regimes. Our study suggests that they did. So we have established a method to detect market regimes in historical data. Each set of regimes that we detected in an experiment can be plotted onto a time TMV space. Here, the x-axis represents the time and the y-axis represents the TMV values. We plot onto this time TMV space all the regimes detected in our experiments. which covered different markets at different times using different directional change thresholds. The orange dots represent a regime with lower volatility compared to the turquoise dots. This is reflected by them having larger time and smaller TMV values. For convenience, we call the orange dot the normal regime and the turquoise dots the abnormal regime. There are certain overlaps between the normal and abnormal regimes, but the two regimes are by and large separable. This was an important discovery. We can now characterize normal and abnormal regimes based on their time and TMV values. Equipped with characteristics of the normal and abnormal regimes, we are now in a position to use real-time data to detect the regime that the market is currently in. To do so, we monitor the market by reading the time and TMV values of the current trend as it develops. Based on the positions of the normal regimes in the time TMV space shown in the previous slide, we can compute the probability of the market being in the normal regime. Independently, we can compute the probability of the current market being in the abnormal regime. We now have two probabilities, one for the normal regime and one for the abnormal regime. We need a rule to determine which regime the current market is in. As a proof of concept, we adopted two simple rules. In our experiments, they managed to estimate the current regime quite accurately. We further showed that the estimations can help us in trading. We can cut our loss if we close our positions when the market changes from the normal regime to the abnormal regime. This is just a start. A lot more can be done in the future to take advantage of regime tracking. To summarize, directional change is a new way to record price changes in the market. It takes an event-based representation of time. Directional change is data-driven in that the data tell us when to sample which transaction. This is different from the time series, which sample transactions at fixed intervals. We have shown that machine learning can help us to recognize regime changes using directional change indicators. We have further shown that one could track regime changes dynamically in the market. This could help algorithmic trading. What is presented in this book is by no means the final product. It is just a proof of concept, pointing to new, promising research directions. To find out more, please refer to our book.